All right, let's talk about the great AI shakeup. Generative AI isn't just another tech trend, it's a genuine earthquake hitting the entire IT industry. And it's forcing everyone to ask who's going to win and who's going to get left behind.
So let's just get right to it with the big question on everyone's mind. Is this the end of the road for the traditional IT services model? You know, the one that's dominated for decades? Well, to figure that out, we've got to first understand how that old model actually worked.
For a long time, the IT services game was pretty straightforward. It was all about people. You hire a ton of smart engineers, you put them on a project, and you bill the client for their time. The whole business is built on these billable hours for things like coding, testing, and support. You know, routine, repeatable work. But here's the kicker. What happens when AI gets really good at doing that exact same work?
And that brings us to the core conflict, the real battle line being drawn. On one side, you've got the old guard, the big IT service firms. Their value is tied to people's time, so AI looks like a massive threat. It risks turning what they do into a cheap commodity. But on the other side, you've got this new breed. These are companies focused on deep engineering or selling their own software. For them, value comes from original ideas and unique intellectual property. And for them, AI isn't a threat, it's a rocket booster.
Okay, so let's dig into that first group a little more. We're talking about the giants, the big traditional services companies. Why are they the ones feeling the most pressure right now?
You got to think of these companies like supertankers. They are enormous and powerful, but they just can't turn on a dime. Their whole business, their bread and butter, is built on those repeatable tasks that are just perfect for AI to take over. All of a sudden, the game isn't about how many engineers you have. It's about whether you can deliver truly unique solutions. And when you're a company like TCS or Infosys with hundreds of thousands of employees, well, trying to upskill that entire workforce for this new AI world is a truly massive challenge.
And hey, don't just take my word for it. When you read what the industry analysts are saying, the phrase that keeps coming up is a painful transformation. It's not that these companies are going to vanish overnight, but the road ahead means shifting from a business of people to a business of solutions. And that's a tough, painful pivot to make.
So, if the supertankers are in for a rough ride, who's actually set to win here? This is where we get to the specialists. These are the companies whose business models aren't just surviving AI, they're actually designed to thrive with it.
First up are the ER&D firms, that's engineering, research, and development. And the key thing to get here is that for these guys, their actual product is original thinking. They're not just writing generic code. They're doing deep, complex engineering for very specific fields like automotive tech or medical devices.
So what does that actually look like? Well, think about it. An AI can write tons of code, sure, but it has no clue about the physics of a car crash. It doesn't understand the safety regulations for a pacemaker. The engineers at firms like KPIT or Tata Elxsi, they're the expert guides. They bring that deep, real-world knowledge and use it to direct the AI. So AI becomes this incredible tool that helps them solve harder problems and design way more complex stuff way faster. The AI doesn't replace the expert engineer. It makes them a superhero.
Now, the second group that has a huge advantage here are the companies that build and sell their own software products. So think of a company like Intellect Design Arena, which makes these incredibly complex banking platforms.
For these product companies, AI isn't some scary thing coming from the outside. It's a massive opportunity they can build right in. They can bake AI directly into their software, creating what's called a competitive moat, something that makes their product unique and really hard for anyone else to copy. And the real magic here is scalability. The revenue comes from selling more licenses or subscriptions, not from hiring more people. AI just lets them build and improve these super valuable products even faster.
Okay, so that's the theory. That's the story of who should be winning. But is the market actually buying it? As they say, follow the money. Let's take a look at how investors are actually valuing these different kinds of companies.
Let's just ask the question straight up. When you look at the numbers, who is the market putting its money on to be the long-term winner in this new AI-powered world?
And this, right here, is where the picture becomes crystal clear. Just look at the PE ratios. That's basically a measure of how much investors are willing to pay today for a company's future profits. The specialists, your KPIs, your Tata Elxsi,
They're trading at valuations that are double, or even more than double, the big service guys. That huge premium tells you everything. The market is betting heavily that these specialists are the ones who are going to grow much, much faster.
Let's zoom in on just one number here to really see what's going on. This is the PEG ratio for KPIT. Now what this does is it takes that high PE ratio we just saw and compares it to the company's expected growth rate. And a number under 1, like this 0.94, is a signal that many investors look for. It suggests that even with the high price, the stock might actually be a bargain because its massive growth potential isn't even fully priced in yet. So the market sees huge growth and it thinks it's getting it at a pretty attractive price.
Okay, but it's not all sunshine and roses. Despite this really strong long-term story for the specialists, if you've looked at their stock prices lately, a lot of them have been getting hammered. So what gives? We need to separate the short-term noise from the long-term signal.
Right, so you have to see this as two different weather systems. Right now, there are these short-term cyclical headwinds hitting everybody. The global economy is shaky, so clients are getting nervous, they're spending a little less, and they're taking longer to sign big deals. That's a temporary storm. But the long-term structural tailwinds, those are still blowing like a hurricane. Things like the massive shift to electric and software-defined cars, the move to digital factories, and of course, the unstoppable need for AI solutions, those trends are not going away.
So what's the forecast? Well, the general consensus is that the next 6 months or so could still be a bit choppy as that economic uncertainty lingers. But the expectation from both analysts and the companies themselves is that things should start to pick back up in the second half of the year. The key takeaway is this. Don't confuse short-term pain with a broken long-term story. For these specialized companies, that growth story is still very much intact.
Which leaves us with one final big question to chew on. As AI continues to just completely rewrite the rules of the game, it really feels like the old model of just being big isn't an advantage anymore. It might even be a liability. And deep, focused expertise is becoming the most valuable asset you can have. So you have to wonder, in the age of AI, is specialization the only true safe haven? That's definitely something to think about.